Anthropic's $1.2 trillion valuation risk urges business leaders to strengthen AI capital strategy and build sustainable growth. You are looking at a massive wake-up call in the AI space because Anthropic's mind-boggling $1.2 trillion secondary market valuation is forcing you to completely rethink your capital strategy before your roadmap collapses. If you think this is just another tech milestone, you need to look closer at how this eye-popping figure demands that you build sustainable growth instead of just riding a wave of private market hype. You might be shocked to learn that this stunning $1.2 trillion valuation actually represents an insane 550% year-over-year growth rate for the company. Just weeks before this spike, the company secured a $965 billion valuation during a massive $65 billion Series H financing round, showing you exactly how fast the capital cycle is moving. Because Anthropic has now confidentially filed for an initial public offering, you are officially entering a high-stakes era where public market transparency will judge every dollar you spend. When you look at how fast things are expanding, you have to realize that this pricing is happening in an illiquid secondary market where shares are exceptionally scarce and tightly held. Market reports show that completed transactions are actually quite uncommon because very few early shareholders are willing to sell their stakes to you or anyone else. Impact Solutions points out that this limited supply creates massive artificial scarcity premiums that can easily trick you into overestimating broad market liquidity. You should note that Anthropic is currently generating an annualized revenue run rate approaching an incredible $47 billion, making it one of the fastest-growing software businesses ever seen. Even with a $47 billion run rate, you must recognize that a valuation crossing the $1 trillion mark demands absolutely flawless future free cash flow and enterprise adoption from day one. If you look at the wider market, global hyperscale cloud providers are aggressively dumping tens of billions of dollars annually into AI infrastructure right now. To understand the scale of this pressure, Impact Solutions highlights that AI-related capital expenditure from major hyperscalers is expected to stay well above $300 billion to $400 billion annually. You are competing in an environment where global AI infrastructure investment is projected to skyrocket past $500 billion, forcing you to prioritize operational efficiency over raw growth. Your competitive landscape is intensely crowded, especially with OpenAI holding a massive secondary market valuation near $908 billion. With a valuation gap between market leaders now measured in hundreds of billions of dollars, you can no longer get away with showing incremental model improvements to your board. You should adapt to the fact that enterprise customers are turning into highly disciplined buyers who care way more about total cost of ownership than vanity benchmarks. If you want to win over these corporate buyers, your AI strategy must prove measurable productivity gains, cybersecurity resilience, and clear governance controls. Pension funds, sovereign wealth funds, family offices, and strategic corporate players are all aggressively fighting you for exposure to these scarce frontier assets. Impact Solutions warns you that valuation momentum should never be confused with intrinsic economic durability, no matter how much optimism is swirling around. When you look under the hood, you'll see that training these elite large language models requires clusters packed with tens of thousands of advanced GPUs. You need to prepare your balance sheet for multi-billion-dollar data center investments, high-speed networking, and rapidly expanding electricity capacity. Because leading developers are collectively spending tens of billions of dollars on compute and talent annually, your revenue numbers don't mean a thing unless your operating margins scale too. You must acknowledge that many Fortune 500 organizations are still running tightly controlled pilots rather than full enterprise-wide deployments because integration is so incredibly complex. Central banks are keeping monetary policies relatively restrictive, which instantly raises the discount rates you must use to value your future AI cash flows. To keep your strategy alive, you have to square off against giants like Google DeepMind, xAI, Meta, Amazon, and Microsoft, who are all investing aggressively across the board. Your real sustainable advantage isn't going to come from launching a bigger model. It will come from maintaining lower inference costs and delivering faster execution. Impact Solutions advises you to stop evaluating AI vendors based on headline-grabbing valuation rankings and start looking at customer lifetime value. If you want to prove your enterprise value is real, You need to consistently maintain an annual revenue growth rate well above 50%. You should ruthlessly target gross margins that comfortably exceed 65% to 75% across multiple reporting periods to stay healthy. To ensure your business model is highly resilient, you need to lock in a customer retention rate that stays strictly above 95%. Your net revenue retention needs to climb higher than 120% if you want to prove that your enterprise clients are deeply dependent on your product. If you want to survive the accelerating infrastructure spend, your executive leadership must implement quarterly capital efficiency reviews immediately. You should actively aim for a return on invested capital that hits above 15% to satisfy your investors. Your team needs to keep overall infrastructure utilization rates tightly exceeding 80% to ensure you aren't wasting expensive compute power. To safeguard your long-term shareholder value, you must ensure that your annual operating expense growth always remains securely below your revenue growth. You need to protect your business from concentration risk by ensuring that no single customer contributes more than 10% of your annual recurring revenue. If you want a highly resilient setup, make sure your top 10 enterprise customers collectively contribute less than 35% to 40% of your total revenue. You can dramatically improve your gross margins by establishing firm internal targets to slash your inference costs per token by 20% to 30% every single year. Your technical team needs to push your specific GPU utilization rates above 85% through smart scheduling and model optimization. You should aim to optimize your overall workload scheduling efficiency past 90% while keeping cloud resource waste strictly below 5%. L-Impact Solutions recommends that you maintain a board independence level above 60% to ensure mature public corporation governance standards. Your executive team needs to execute deep dive enterprise risk assessments every 90 days without exception to catch vulnerabilities early. You must demand 100% compliance with major AI governance policies and back it up with annual external cybersecurity audits. To handle sudden market shifts smoothly, your financial strategy must maintain a strong current ratio that sits comfortably above 2.0. You need to keep enough hard cash reserves on hand to completely finance 18 to 24 months of strategic operations without needing external funding. Your innovation focus needs to shift away from chasing raw benchmarks and head toward tracking customer productivity improvements that exceed 20%. You should design your enterprise deployment frameworks to push your implementation success rates well above 90%. If you want to dominate the market, you must use standardized deployment methods to cut your customer implementation timelines down by at least 30%. Your customer success teams need to consistently secure average customer satisfaction scores that land above 4.5 out of 5. You should establish an ironclad governance cadence that includes board-level strategic reviews at least 4 times every year. To keep your balance sheet bulletproof, your business should aggressively target a free cash flow conversion rate that sits above 20%. You must enforce strict data center efficiency guidelines by striving to keep your power utilization effectiveness rating below 1.2 wherever feasible. Your operations require a minimum infrastructure availability SLA that guarantees uptime above 99.95% to maintain enterprise trust. You should diversify your revenue streams so that no single industry vertical ever accounts for more than 25% of your annual recurring revenue. To shield your company from localized regulations and shocks, you must deliberately expand your geographic presence across North America, Europe, and Asia-Pacific. Your security teams must achieve 100% multi-factor authentication coverage for every single privileged user on your network. You need to keep a close eye on organizational health by implementing a talent strategy that keeps voluntary employee attrition well below 10%. Your risk management plans must feature robust leadership succession blueprints that fully cover 100% of your critical executive roles. You should mandate that annual technical training participation across your research teams stays firmly above 90% to maintain your edge. Your leadership team must run rigorous, continuous financial stress tests that extend 24 to 36 months into the future to survive unexpected market crashes. Will your AI strategy survive a $1.2 trillion valuation reality check? Comment below. For more strategic analyses, visit our business consultancy website, link in the description below. Thank you.